with VWAP today as well. In addition, XLP and IMVT. I keep seeing the XLP. We sold some spreads on this last week. Continuation of trend here. This is all focusing on looser economic financial conditions, combined with, relatively simply speaking, the idea that rate cuts in the future will help alleviate a lot of the pressure on the consumer staple space. I like just the continuation of that trend. If you are looking for a trade on the XLP, this one's pretty easy. Basically, you're going out into, you're going to get a trade out of it. Look, took us some time. You're going to go out to basically April. No, forgive me. Go out to there is no February. You're going out into the period here, 78. Selling the 78 on the 16 and buying the 76. This is a much higher probability of profit trade. 78% probability of profit, 34% max return on risk. If you are down 30%, you cut the trade. If you move up toward about an 18% return, that's a move up toward about $80.50. You would sell it back, or forgive me, buy the spread back and take the win. 149 to make 51. Once again, you're focusing down here in this range where we hit these recent lows for December 5th. That is the 78.76 for January. If you want to go a little bit more conservative, which isn't a bad thing to do, you may look at something like the 77.75, which will likely pay somewhere in the range of 85% probability of profit and about a 14% return. All right, last thing. I don't know anything about this stock. It just showed up this morning when we were looking at insiders. IMVT, biotech name, on the daily has just been running. I don't know much about this, but what I do know is that these are the types of names that can lead to very violent, wild swings in the biotech space when we get sizable insider purchases. We saw a lot of insider activity in a couple of these names. IMVT, we've seen it in SMRT, which is Smart Rent. The executive CEO of the company has been buying into this stock going back to around $1.58. It has been very strong momentum as well. With insiders stepping in and buying their stocks, IMVT, SMRT, they become momentum trades with tight stops, and we try our best not to shake up the trade too much. A, B, and B, Airbnb. This has been a nice run that we've seen over the last couple of days, going back to November 21st. Once again, big questions around broader momentum in the market. This is just one to keep an eye on because of the consumer cyclical nature. If this rolls over at around 130.20, that may be a nice short back to around that 122 level. RIG, energy names have been under some pressure in recent days. Rig has been selling off. And the big question right now is what's going to happen with Venezuela. But oil prices are down again this morning. They continue to bleed off. Natural gas continuing to sell off, money rotating into the metals, not the liquid commodities. And the last one is TEL, which, good company, teleconnectivity, but these are names that have been under some pressure as well. And if money continues to rotate out of tech and out of EM or foreign countries and rotates back into U.S. equities, this can continue its move down to 15 on the weak side. All right. That was a lot. Is it my eyes or are the charts blurred? It's your eyes. I'm sorry. It's a shame. Freaking new guy. All right. So let's slow it down. Like Bismarcky. All right. As I said, I was sleeping on my couch. I didn't even do anything wrong. I was just sleeping on my couch. And woke up and wow, did my back hurt. Why is it doing this? Stop doing that. Something's going on with this screen share. It keeps, I don't want to rotate. I don't want to, oh my gosh, I hate these things. I'm bad at technology and I get it. All right, so I'm lying on the ground in my bathroom after the back spasm, and my wife called for me, very nice woman, and basically said, look, we're going to have to get you some muscle relaxants. Okay, so I was just on that ground for a nice while, and I had just read an article by Michael Howe over at Cross Border Capital, and we were talking about or reading about how basically he has argued something pretty simple, and I can't refute it in any way, and I've studied it up and down, but basically this: Bitcoin is the most liquidity-sensitive asset on the planet. Liquidity-sensitive asset, on the planet, right? So we watch Bitcoin ebb and flow with the rise and fall of liquidity cycles dating back to 2010. And his argument is pretty simple. If you track global liquidity, if you track the Fed's reserve management purchases, if you track what the Treasury's doing, what China's doing, you can model where Bitcoin is heading. And he's actually bullish on Bitcoin heading into 2026. So the logic is clean. And I agree with that. But we have this debate about Bitcoin, about modeling it and trading it and hedging it. And when it's acting like something else completely different than what the Bitcoin has been pitched as. And I remember there was a conversation I had with Don after Bitcoin rallied on the backside of the April sell-off. And I explained, well, yeah, it's a liquidity proxy. It's a forward-looking mechanism of what our expectations will look like with capital in the system. But then I just started to think about it on the ground, and I said, what if I'm wrong? And what if everybody's actually wrong about it? And that none of this stuff matters about whether it's in a bubble or whether it's investable or not. This isn't an endorsement of Bitcoin. It's not a rejection of it. It's just a alternative theory. Because at the end of the day, it took me all weekend to get to one sentence, and that is that Bitcoin helps convert monetary excess into volatility rather than social or economic stress. Now, what the hell does that mean? So here's the thing. When government actually monetizes debt, money has to go somewhere. Money has to flow somewhere. It is like water. It goes downhill and it finds the path of least resistance. But here's the issue. And again, I'm not saying that Bitcoin is large enough to drive a macroeconomy. That's not the claim. The claim that I'm going to make here is that it is shaped in a way that makes it a safe place for volatility to live and for money to move quickly. It's got to go somewhere. And it can't go into food prices or else people riot. It can't go into energy prices or else inflation spirals. It can't go into housing or else social cohesion breaks. It can't go quickly into wages because that leads to policy tightening, and sometimes violently. It can't go into treasuries because funding markets will get distorted. It can't go too heavily into equities or else inequality becomes political. And the point is, every other asset out there is load-bearing. They affect daily life. They affect voting behavior, and people have short memories, but know that there's something off about the system itself. So the question that I have and the question that I'm making here and point that I'm making is Bitcoin is the asset. And I know that it's only $1.7 trillion in market capitalization, but it is the marginal, highly speculative liquidity that does not transmit directly into the prices that people live on. It is very loud, but it is very economically quiet. Very loud financially, very economically quiet. There's no immediate policy response to Bitcoin. It's the only asset that I can think of that doesn't have a policy response. There's no rent hike. There's no grocery shock. There's no wage negotiation. There's no CPI impact. Instead, what I'm arguing is that it actually is structured and acts like a pressure valve for liquidity. And it does so almost too perfectly. And the reality is this. It doesn't matter what the size is. And I made this statement. A sword does not need to be bigger than the city itself. It just has to exist, meaning that it has to go somewhere. And that has been the element of decentralization and everything that we were pitched is not Bitcoin's primary role. It is a shock absorber. And that's very important because when money flows quickly, Bitcoin is really, at the end of the day, one of the very few things, if anything, that can absorb the size of liquidity injections very quickly, trade continuously, and fail without consequential failure. My point is just simple. It's not virtuous, but it becomes a pressure outlet alongside an expanding money supply and loose fiscal and monetary policy for 5 reasons. And it's the only asset that I can argue fits these 5 things. It can absorb size quickly. It sits outside of consumer price index and consumption patterns. It doesn't put stress on balance sheets. It has a supply that does not respond to demand, and it works globally without permission. Liquidity always finds the path of least resistance, and Bitcoin has become a clear path. And the reality is this. If the function as a pressure valve is for excess liquidity, then it's not disrupting anything in the monetary regime like the Winklevoss brothers promised. Instead, it's actually helping our financial system endure. Its volatility is tolerated because the costs are politically invisible, and it may be less revolutionary than it is an emerging stabilizer within the very system that the evangelist claim to oppose. So whether this outcome is emergent or merely tolerated, but the real question we have to continue to basically focus on, what will future liquidity shocks and policy responses look like? A lot of people will debate the first order questions on Bitcoin. Is it a hedge? Is it money? Is it a bubble? Is it useful? And I'm asking, why does the system allow this thing to exist, grow, and violently fluctuate without stepping in? And it's a political economy question. It's not a crypto one. The point that I'm making is that it is the perfect asset for capital liquidity expectations. And when we see the central banks stepping in, and when we see policy changes, it is no shock to me that Bitcoin moves as violently and quickly as it does. And I know that a $1.7 trillion amount is not significant, but what's global food? Something like 9 to 10 trillion? If that money flowed into food, it would not end well. And I will remind you that we had that happen back in 2008. That is where we had riots on food prices, and that is where we saw destabilization. The crypto markets, I'm just simply asking, and I want people to think about it, is pretty simplistic. It is a drain pipe for liquidity to flow and for people to speculate and trade and guess and basically win and lose without real world consequences. So, what's the point? The point is, when you hear central banks engaging in monetary policy actions that are very, very fiscally loose, when they're turning the pumps back on, when the water is starting to gush downhill, it can flow many different ways. And the path of least resistance is very clear. It's this particular asset because, once again, there are no consequences for its movement and for its emergence. Keep that in mind because, yes, it might not have any utility, but it certainly is a place where all of that water can run. All right? So, it is 9:20. I hope I confused you thoroughly, and we will go from there. Again, the whole point here is all roads point to more monetary expansion. When you see markets overbought, when you see insiders stepping in, when you see speculation start to return to the market, have a position in Bitcoin, have a position in gold, all roads point to monetary inflation. Don's coming up right now. He's going to try to make sense of what I just said, and we will go from there. And I will be back today at 3 o'clock for more to talk about what capital efficiency will look like moving forward and what will be the expectations for a Warsh or Hassett regime in the Federal Reserve. Again, name your price, click the link. We will catch up with you later today. Take care, everybody.